Hello everyone, my name is Kyle Nickerson and I'm a wealth manager, certified financial planner, and certified investment management analyst here at Raymond Gurrell Wealth Management. Today, we're going to be talking about early retirement distributions, specifically IRS Section 72T and the Rule of 55. If you or someone you know could benefit from these strategies or the other services that our firm offers, feel free to contact our team for a complimentary consultation, where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefits, and retirement strategy perspective. The IRS has historically forced retirement savers to wait until age 59 and a half to start withdrawing assets from their IRAs or employer-sponsored retirement plans without penalties. These restrictions were put in place to incentivize long-term retirement savings and generally deter withdrawals during your working years. However, many individuals find themselves financially ready to retire before the age of 59 and a half. What many investors don't know is that there are various rules that allow them to withdraw funds from their retirement accounts before 59 and a half without incurring any penalties. Some of these rules are for major life events, but there are two that are clearly oriented towards individuals who wish to undertake early retirement: IRS Section 72T and the Rule of 55. IRS Section 72T allows individuals to take penalty-free distributions from their qualified retirement accounts before reaching age 59 and a half. Under this rule, participants must commit to withdraw periodic payments for a minimum duration of 5 years or until they turn age 59 and a half, whichever is longer. To avoid a tax penalty, these distributions must be considered substantially equal periodic payments by the IRS. Individuals must choose one of 3 IRS-approved methods to determine the amount of their substantially equal periodic payment: the required minimum distribution method, the fixed amortization method, and the fixed annuitization method. Each of these methods use the IRS Uniform Lifetime table to calculate annual distributions based on life expectancy, the account balance, and other factors. The RMD method often yields the lowest annual payout, while the fixed annuitization method often results in the greatest annual payout. Once the substantially equal periodic payments commence, individuals must continue taking that calculated payment for the predetermined period, regardless of their financial circumstances. Discontinuation of payments before the minimum duration has elapsed can result in a retroactive penalty for the entire period. One item of note: investors are also able to use the calculation of one specific IRA account rather than being forced to consider all of their IRA assets in the calculation. Additionally, in some cases, individuals may change the calculation method without ceasing distributions or violating the rule. While the 72T tax rule waives early retirement penalties, distributions taken under the substantially equal periodic payments are still subject to ordinary income tax. It is also worth noting that withdrawing funds from retirement accounts earlier than planned can significantly impact your long-term savings goals. It is important to carefully consider your specific situation with a financial professional such as our team before pursuing this strategy. The Rule of 55 allows workers who leave their job for any reason upon reaching age 55 the ability to take penalty-free distributions from their most recent employer's retirement plan. In order to utilize this strategy, the company's 401k plan must have a provision allowing for these distributions, and most of them do. Some 401k plans allow for many Rule of 55 distributions as the participant wishes to take, but others limit the number of annual distributions that are available. This rule also applies to 403(b) plans, but does not apply to IRA accounts. The Rule of 55 applies only to retirement savings in the employer-sponsored retirement associated with the employer from which the individual most recently separated from. This means that if the individual gets another job and is covered by a new 401k plan, they are no longer eligible for the Rule of 55. Similar to the 72T strategy, distributions will still be taxable in the year that they're taken. Please be aware that there is a mandatory 20% minimum tax withholding requirement on Rule of 55 distributions. Unlike 72T, the Rule of 55 does not require a certain amount to be withdrawn each year. Now let's break down some of the key differences between the Rule of 55 and 72T. 72T payments can start at any age prior to reaching age 59 and a half, while the Rule of 55 allows penalty-free withdrawals at age 55 or later. While Section 72T applies to all types of qualified retirement accounts, the Rule of 55 exclusively pertains to employer-sponsored retirement plans like 401ks and 403(b)s. The Rule of 55 offers more flexibility as individuals can make one-time withdrawals or take periodic withdrawals as needed, but subject to employer rules on the plan. 72T necessitates consistent, predetermined withdrawals for the entire duration of the commitment period. Both the 72T rule and the Rule of 55 allows taxpayers to access their retirement savings penalty-free prior to reaching age 59 and a half. They each have different rules that govern them, and if executed incorrectly, can result in adverse consequences for the taxpayer. Investors should carefully consider how these rules work, as well as the advantages and common pitfalls before deciding which option is best for them. We recommend consulting a financial professional before transacting on any of these strategies. At Raymond Grell Wealth Management, we have over $1 billion in assets under management, and as a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. Our team of CFP and CPA professionals specialize in helping clients take advantage of advanced financial strategies to materially enhance their ability to enjoy life before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.